Good morning and welcome back to Almus Market Mornings. There's a common expression that bond markets are the canary in the coal mine for the economy. For those who don't know what this means, essentially canaries are birds and they were used to detect toxic gases from coal mines since they exhibit symptoms earlier than humans. It seems the Japanese bond markets are trying to tell us something. The yields are rising, the 10-year hitting the highest level since 2008 and the 20-year hitting the highest since 2000. And it's not just Japan. Ultra long yields are rising for other developed markets like the US, EU, and the UK as well. Meanwhile, yesterday the inflation print from India came in even lower at 2.1% for the month of June against a consensus of 2.5%. And now that's something that should ideally keep the yields lower. Good morning, JK. Can you break this down for our listeners? Ultra long yields rising, how would it impact countries?
Hey, good morning, Swaraj. Yes, actually, the focus is shifting in the market slowly away from the tariff to bond market. The reason being, Trump has almost, indicated the level of tariff that he would be imposing on major countries. Of course, Indian deal is yet to be signed, and at the same time, he has also given 50 days time to Russia to stop the war before he imposes the penal tariff of 100%. And even for EU and other, he has said that he's open for negotiation. So that kind of gives some calmness on the tariff front. But everything is not calm in the market. As I said, the bond yields are rising everywhere. JGBs, the Japanese government bond yields, are rising across tenors 10, 20, 30, 40, are all reaching previous highs, multi-year highs. And it's also along with the yield rising in the US. 30-year yield is now again approaching 5% in US, and 10-year is also pushing towards 4.45%. In Europe as well, we are seeing the 10-year yield rising towards 2.75%, which is a key resistance. Now, all these are happening. Background of this is fiscal concerns. Now, in US, we know already that they have a high fiscal deficit, and the rising yields are going to make it even more difficult. And then in Japan, there's going to be an election where to the upper house, and the new party, which is likely, which is expected to do well, is promising high fiscal spending. In Europe, we know that after the stoppage of funding for NATO by the US, European governments are planning to spend a lot more on defense and also on infrastructure. And this is likely to push up the yields once again. So fiscal concerns are taking a huge amount of burden into the yields, and they are rising. And this has a huge implication, particularly if you look at the Japanese yield rising. They have a huge implication overall for the global markets. They will pressure the global bond market. They will cause risk asset corrections because if you go beyond a certain level, the financing of the debt will become difficult. The leverage for leverage for carry trades will also reduce, and they will also probably eventually support yen strength, and that could also lead to the unwinding of carry trades and all that. So while these may not be immediately visible, we need to keep watching these trends in the inflation and the bond yields, and that will be key for how we move towards move forward. But definitely there is a risk involved in the bond yield rising. Yes, we have also had some data from China yesterday and today. Trade surplus in China widened to 114 billion from 98 billion. A lot of exports front loading due to the tariff ahead of the tariffs. This was one of the reasons. But imports also fell. China also announced just now their data on industrial production and GDP again came better. GDP year on year was at 5.2%. Industrial production was at 6.8%. Retail sales was, of course, lower, reflecting consumption, underwhelming. So, of course, we had the Indian retail inflation yesterday, and that came at January 2019 low at 2.1% versus 2.8% that was seen last month, and expectation was 2.5%. Before that, see, this is almost the lowest level near the lower end of the RBI's band of 2 to 6%. Not long ago, we were at 6.21% in October 2024. And before the CPI, we also had the WPI inflation, which actually showed disinflation at minus 0.13%. Food index was a major cause for both both the indexes falling. But then, does it have a policy implication? Not so much, because if you look at the CPI, the month on month actually showed a rise. And why the year on year was high was also because there was a base effect advantage. So that base effect advantage will slowly recede, and inflation rate can be higher. Of course, the food index is also at one of the lowest levels, and probably considering the inherent demand in the Indian scenario and the festival season coming up and all that, we don't see this low level sustaining. So I don't see a major policy implication because of this. Market is now looking ahead to the CPI number from US this month, which is expected to be a bit hotter, with the consensus having all item index and the food and energy, the core index, both of them reflecting some increase due to the tariff impact. And of course, going forward, this might increase for a couple of months. That is the reason why market now expects no rate cut until September. Once the full impact of the tariff is felt, that's when the Fed will reconsider. As of now, there is no yielding to the political pressures that we are seeing on the Fed to ease rates early. On the Indian side, of course, we also had the data which showed inflation easing a lot. Overall, even Indian bond market is showing yields being resilient, and that could be also because of the global pressure, and this could keep the FI flows also in check. Overall, dollar is showing the tendency to strengthen. That what we have been indicating over last several updates, and we are seeing euro slowly inching down towards support at 1.1650. GBP has been much weaker than other currencies, hitting 1.34 levels quickly. Very recently, we had seen 1.3750 as well. Japanese and quite surprisingly, Japanese yields have not supported the yen as of now. I think the market is now looking more at the fiscal side of the equation that can actually see a sell-off in the yen bond by the foreigners as well. That can lead to yen selling. That may be a temporary factor, but eventually, if the Japanese yen yields remain high, it could lead to yen strength against the dollar as well. But overall, there is some short covering that's happening in the dollar that is also keeping the USD INR well supported, and we are almost consistently trading near 86 for almost 26 hours, 24 hours now. But in a broader picture, if you look at it, rupee has quite underperformed the overall dollar index as well as the EM currency index. Rupee has depreciated 0.59% against the dollar in the current financial year, and 0.47% in the calendar year. Uh, Compared to this, dollar index, has fallen 12% in the calendar year, and also, 12% in the financial year and 8% in the calendar year. EM currency index has also risen. Rather, EM currencies have strengthened about 8% in the calendar year and 4%. So, rupee stock underperformance is very visible. A lot of absorption of inflows from RBI has been seen at the lower levels, and we are now at not more than 2% from the peak that was seen. Just about 2 to 2.5% from the peak is what we have seen, whereas dollar index trades well below, almost 10% below its peak. The reason, of course, you can also say that rupee has adjusted its overvalued RER, which had reached about 107 to 108, and now we are near about the fair value. This possibly means that future moves in the rupee will be more correlated to the dollar index moves either up or down, and no major concern about rupee unduly depreciating as of now. It's moving along with the dollar index, and with our current account being under, quite under control, and BOP on a consistent surplus basis, no major rupee depreciation should be seen. But definitely, if the dollar index strengthens, rupee can also weaken further. In case dollar index goes towards 100, we might see that the dollar rupee also inch towards 87. The medium term view on the dollar index as well as the USD INR is still retained. Thank you.
Thank you, JK. And just quickly summarizing, focus for the markets, it remains on the long tenor yields, which are rising due to fiscal concerns. Japan is facing an election for its upper house. The party which is expected to do well promotes fiscal spending. Europe is spending more on defense. So overall, this theme of higher fiscal spending is keeping the long yields elevated. And it is quite significant because Japanese yields rising, it may cause risk asset correction because leverage for carry trades reduces, and it also results in yen strength, which again results in the unwinding of carry trades. So as of now, it's no all of this is not evident, but it's important to keep an eye out for all these implications. When it comes to Chinese data, it was the trade surplus widened to 114 billion. The GDP was at 5.2% year on year, and industrial production was at 6.8%. Indian inflation was at the January 2019 levels. Inflation is at the lower band of the RBI's target range of 2.1%. Largely, the fall is largely due to the food inflation correcting. And in today's data, we have got the US CPI. It is expected to print higher due to the impact of tariffs. That's it from us today. Thanks for listening. We'll catch up tomorrow with the latest in the financial markets.